December 31st, China's Customs Bureau issued a directive, one that changed everything overnight. Physical silver, crossing borders, suddenly restricted. But here's what they're not telling you. While COMEX silver sits at $73 per ounce, Dubai's physical market just hit $127, a $54 gap. And now, China's making their move. The timing? Suspicious. The impact? Catastrophic. Because what happened in the next 48 hours will rewrite the precious metals playbook forever. And if you're holding paper silver, what I'm about to show you could change everything you thought you knew. Welcome to Currency Archive. Now, I know you've seen a lot of financial channels, but if you're someone who values straight facts over hype, someone who's built wealth through decades of experience, then consider subscribing. Because we don't chase clicks, we chase truth. And please, drop a comment below. Where in the world are you watching this from? New York, London, Mumbai, Dubai? Let's see how global this crisis really is. Now, let's get into what China just did. The game has changed. And what just happened in the silver market will send shockwaves across every trading floor from New York to London to Dubai. January 16th, 2025, a Friday. Silver prices dropped over 3%, touching as low as 86, 84 before recovering near the $90 mark. Another classic Friday smackdown, but this wasn't just another routine pullback. Because while Western traders focused on the price action, something far more significant was unfolding 7,000 miles away in Shanghai. The Shanghai Futures Exchange had just issued a directive, one that would fundamentally alter the landscape of global silver trading, and the timing couldn't be more suspicious. Here's what happened. The exchange announced a dramatic reduction in position limits for silver futures, slashing the opening position limits for intraday trading from 7,000 lots down to just 3,000 lots, a 57% reduction, effective immediately on the night session of January 19th, 2025. That's just 3 days away. The official reasoning? To curb speculation amid volatility, following China's new physical silver export restrictions that went into effect on January 1st. But here's where this gets interesting. The Shanghai Futures Exchange isn't like the COMEX. While COMEX operates primarily on paper contracts, the Shanghai market maintains much closer ties to actual physical metal, real silver, real delivery, real consequences. And when a market that's grounded in physical reality starts imposing restrictions, it reveals something critical about supply and demand dynamics, something they don't want you to see, because the restrictions don't stop there. Nickel markets are also being affected, alongside recent hikes in trading margins from 16%, with price limits expanding to match, all designed, they say, to stabilize volume and prevent sharp price swings. But stabilize for whom? And prevent what exactly? Here's the reality most analysts are missing. When you restrict position sizes in a physically backed market, you're essentially admitting one of two things. Either demand has overwhelmed available supply to a dangerous degree, or the price discovery mechanism has broken down so severely that normal market operations can no longer function. Perhaps both, and the ripple effects of this decision could be catastrophic. Because when speculative trades get redirected from Shanghai, where do they go? The COMEX, and the data confirms this is already happening. Open interest at the COMEX has surged 20% year over year according to CFTC data. But here's the problem. The CME has implemented its own risk management changes, tying margin increases to a notional percentage of trade values, a new rule designed to create automatic circuit breakers as prices rise. So far, these margin hikes haven't significantly impacted silver's upward trajectory. But what happens when Shanghai's restricted volume collides with COMEX's automated margin escalators? What happens when thousands of traders, suddenly unable to take positions in Shanghai, flood into New York's paper markets? The volatility that Shanghai is trying to contain doesn't disappear. It simply relocates and intensifies. Consider the current market structure. Global silver spot prices are hovering in the $80 to $89 range. Just earlier this week, $80 was the psychological support level. Now we're nearly $10 above that, sitting just 50 cents shy of $90. Despite Friday's sell-off, despite the mounting restrictions, despite every attempt to cool this market down, silver keeps climbing. The wild swings that traders feared would destabilize the market, they've been minimal. Instead, we're witnessing a steady, relentless march higher. And that's what terrifies the exchanges, because the markets are supposed to move in both directions, up and down, profit and loss, bull and bear. But when a market only knows one direction for an extended period, when it defies every traditional pullback mechanism, when it ignores margin hikes and position limits, that's not a market anymore. That's a braking system. And what makes this situation unprecedented is the historical context. In 2011, when silver briefly touched $50, the rally collapsed under its own weight within months. In 1980, when the Hunt brothers drove silver to similar heights, the bubble burst spectacularly. But this time, it's different. This rally has sustained itself longer, climbed higher, and shown more resilience than any previous bull market in silver's modern history. The fundamentals driving it aren't speculative excess. They're structural deficits, they're supply chain disruptions, they're monetary policy failures, they're the physical reality of a commodity that's being consumed faster than it's being mined. And now, with Shanghai implementing these restrictions, effective January 19th, we're about to see if limiting the game changes the outcome, or if it simply accelerates the inevitable. Because when the Asian markets open Sunday night, the world will be watching. Will traders panic buy before the restrictions take effect? Will volumes surge as participants make their final moves with the old position limits? Will the COMEX absorb the overflow, or will it buckle under the pressure? The answers are coming in 72 hours. And what happens next could determine whether silver reaches $100 an ounce or something far more dramatic. Let's talk about something the mainstream financial media refuses to acknowledge. There are now two completely different silver markets operating simultaneously on this planet, and the price gap between them is absolutely staggering. While COMEX silver trades around $89 per ounce in New York, physical silver in China is commanding well over $100 per ounce. Let that sink in for a moment. The same metal, the same chemical element, Ag47 on the periodic table, trading at radically different prices. Depending on which side of the Pacific Ocean you're standing, this isn't a minor arbitrage opportunity. This is a complete breakdown of global price discovery. And it explains everything about why Shanghai just imposed these emergency restrictions. Bob Coleman, a respected market analyst, offered a fascinating interpretation of what's really happening. According to Coleman, the language coming from the Shanghai Futures Exchange reveals something critical. Now, this isn't about speculation. This is about maintaining an orderly market in a situation that has become fundamentally disorderly. And when you dig into the physical markets in China, you start to understand exactly what he means. Chinese traders have been physically carting around 15-kilogram silver bars, these massive raw silver slabs, moving them through the streets like never before. Why? Because the price premium for physical delivery in China has been trading comfortably above $100 per ounce, while paper contracts in New York struggle to hold $90. This is the East-West disconnect in real time, and it's tearing the global silver market apart at the seams. Think about the mechanics here. If you can buy a COMEX silver contract for $89, take delivery, ship the physical metal to China, and sell it for $100 plus. That's an instant $11+ profit per ounce, minus shipping and insurance costs. But still, a guaranteed arbitrage, except it's not happening. Why not? Because the physical metal isn't available for delivery in the quantities needed to close that gap. The COMEX vaults in New York, the refineries in Switzerland, the storage facilities in London, they're all reporting the same thing: tight supplies, delayed deliveries, unprecedented demand, and now China has effectively closed the door on exports, trapping whatever physical silver exists within their borders, creating a pressure cooker environment where domestic demand keeps pushing prices higher and higher. So Shanghai's exchange had no choice. They had to do something to manage the chaos. Managing risk and volatility, as they put it, is paramount to the success of their members, because exchange members don't want to get caught in a situation where they are losing catastrophic amounts of money. They don't want the stress and strain of a market that moves 5%, 10%, 15% in a single session. And they certainly don't want to face delivery failures. Which brings us to an interesting question, one posed by traders in the community. Why not just hike margins to 100%? If the goal is to reduce leverage and speculation, why mess with position limits at all? Just require full cash backing for every contract. Make traders prove they have the money to take actual physical delivery. Problem solved, right? The happy Hawaiian, another keen market observer, suggested exactly this, but the reality is more complex, because raising margins alone doesn't solve the underlying structural problem. And that problem is this: there isn't enough physical silver available to satisfy the demand that exists at current prices. When you have genuine supply deficits, no amount of margin manipulation fixes it. You can make it more expensive to trade. You can limit position sizes. You can create circuit breakers and cooling off periods, but you can't conjure silver out of thin air. And the Shanghai Futures Exchange knows this. That's why their approach combines margin hikes, position limits, and coordination with China's export restrictions. It's a multi-layered strategy to manage an impossible situation. Now, here's where the COMEX comparison becomes critical. The COMEX recently implemented their own version of risk management, tying margin requirements to a notional percentage of spot prices. As silver climbs, margins automatically increase, theoretically creating a natural brake on speculation. But so far, this hasn't slowed silver's advance. The metal keeps climbing regardless, and that's because the COMEX operates primarily in paper. Contracts settled in cash, very little actual metal changing hands. It's a different beast entirely from Shanghai's physically oriented market. This fundamental difference between the two exchanges explains why they're responding so differently to the same price surge. COMEX can manage paper volatility with automated margin adjustments, but Shanghai, dealing with real metal, real deliveries, real logistics, they need hard limits. They need to physically restrict how much metal can be committed to futures contracts. Because every contract in Shanghai carries the implicit threat of physical delivery, and when the physical metal isn't there to deliver, the whole system breaks down, which brings us back to those 15-kilogram silver slabs being carted through Chinese streets. That's not speculation. That's desperation. That's what happens when people realize paper promises won't protect their wealth, when they understand that only the physical metal matters, and when they're willing to pay $100, $100, $120 per ounce to secure it. While New York traders play with paper contracts at $89, the disconnect couldn't be more obvious or more dangerous, because eventually, one of these markets has to give. Either New York's paper prices surge to meet Shanghai's physical reality, or Shanghai's physical market collapses back toward COMEX's paper fantasy. There's no middle ground, no compromise, no equilibrium where both price structures survive. And Shanghai's exchange just signaled which outcome they're preparing for. By restricting positions, they're acknowledging that physical demand has overwhelmed available supply, that the price in their market reflects reality, while the COMEX price reflects something else entirely. There's a clock ticking, and when it hits zero, everything changes. Sunday night, January 19th, 2025, the Asian markets open, and for the first time in silver's modern history, traders will be operating under a completely new set of rules. Rules designed to contain what may already be uncontainable. But here's what makes this moment absolutely critical. The restriction doesn't just limit future positions. It creates a window, a narrow 72-hour window where the old rules still apply, where traders can still take 7,000 lot positions, where the game can still be played the old way. One last time. And what do you think is going to happen in that window? Exactly. Panic buying, traders rushing to establish positions before the door slams shut, volume surging as participants make their final moves with maximum leverage, the very volatility Shanghai is trying to prevent, amplified by the announcement itself. It's the classic regulatory paradox. By telegraphing restrictions in advance, you create the exact chaos you're trying to avoid, and the markets know it, which is why every serious silver trader on the planet will be glued to their screen Sunday night, watching, waiting, ready to react to whatever madness unfolds when Shanghai opens. But there's another layer to this that most people are missing. The timing isn't random. January 1st, China restricts physical silver exports. January 19th, Shanghai restricts futures positions. These moves are coordinated, sequential, building toward something, and that something could be the destruction of two major banks. Yes, you heard that correctly. Two big banks are sitting on massive short positions in silver. Positions that were profitable when silver traded at $25, $30, even $50 per ounce. But at $90, approaching $100, these positions have become catastrophic liabilities. Billions of dollars in unrealized losses, growing larger with every uptick in silver's price. And here's the nightmare scenario these banks are facing. If silver hits $100 per ounce, their collateral requirements explode, their risk models break, their counterparties start asking uncomfortable questions. And if silver keeps climbing beyond $100 toward $110, $120, the losses become unsurvivable, not just for the banks, but for their clearing members, their prime brokerage clients, the entire interconnected web of financial institutions that have bet against silver's rise. Shanghai's restrictions, in this context, aren't just about managing volatility. They're about preventing a systemic banking crisis. Because if silver's price continues its relentless march higher, if the physical paper disconnect keeps widening, if delivery failures start cascading through the system, those two banks won't be the only casualties. They'll just be the first. Now, let's talk about what happens after January 19th, after the restrictions take effect, after the initial volatility subsides. What then? Some analysts believe this marks the beginning of the end for silver's bull run. That by limiting speculative excess, Shanghai will cool the market, allow prices to stabilize, perhaps even decline. returning silver to some semblance of normalcy. But here's why that analysis is dangerously wrong. The restrictions don't address the underlying fundamentals. They don't create new silver supply. They don't reduce industrial demand. They don't solve the structural deficit that's been building for years. All they do is suppress the symptom while ignoring the disease. And suppressed symptoms, eventually, explode. Think about it this way. When you limit position sizes, you're essentially rationing access to the market, creating artificial scarcity on top of real physical scarcity, which doesn't lower prices, it drives them higher. Because now, not only is physical silver hard to obtain, but even paper exposure to silver becomes restricted. Double scarcity, double pressure, double the reason for prices to climb. So while Shanghai believes they're implementing a cooling mechanism, they may have actually lit a fuse, one that leads directly to $100 silver, and potentially far beyond. The question isn't if silver reaches $100, it's when, and what breaks when it does. Because at $100 per ounce, the psychological barrier shatters. Every investor who's been sitting on the sidelines, watching, doubting, hesitating, they'll rush in, FOMO will grip the markets, and the very volatility Shanghai tried to prevent will return with a vengeance. Only this time, it won't be in Shanghai, it'll be in New York, London, Zurich, every silver market simultaneously. Because once the $100 level breaks, there's no obvious resistance above it. 10, 120, 150. No one knows where it stops. And that uncertainty, that lack of historical precedent, creates the most dangerous kind of market environment, one where traditional risk models fail, where algorithmic trading systems malfunction, where human judgment gets overwhelmed by fear and greed. But here's the fascinating part. Even if prices do pull back after the initial surge, even if Shanghai's restrictions temporarily cool the market, the underlying structural deficit remains. Silver is being consumed in solar panels, electronics, batteries, industrial applications, at rates that far exceed new mine supply. Every year, the deficit grows. Every year, above-ground inventories shrink. Every year, the gap between supply and demand widens, and no amount of position limits, margin hikes, or regulatory intervention changes that math, which means this isn't a bubble, it's not speculative mania, it's not irrational exuberance, it's a genuine supply crisis, manifesting in rising prices. And the longer authorities try to suppress those prices through market manipulation, the more violent the eventual correction upward will be. Shanghai knows this. The COMEX knows this. The two banks sitting on massive short positions definitely know this. Which is why, when those Asian markets open Sunday night, when the countdown reaches 0, when the new restrictions take effect, we're not witnessing the end of silver's bull run. We're witnessing the beginning of its final, most explosive phase, the phase where $100 isn't the ceiling, it's the floor. And what comes after will rewrite every assumption about precious metals markets. 3 cities, New York, Shanghai, London, 3 massive vaults holding the world's silver reserves. And right now, all 3 are staring at the same terrifying reality. The equilibrium is broken, perhaps permanently. Let me explain what equilibrium actually means in the context of global silver markets. For decades, silver flowed seamlessly between these 3 financial centers. When prices rose in London, metal shipped to New York. When demand surged in Shanghai, vaults in Switzerland sent supplies east. The system balanced itself, supply meeting demand, prices stabilizing, markets functioning. But that delicate balance, that decades-old mechanism, has shattered. And what we're witnessing now isn't a temporary disruption. It's a fundamental restructuring of how silver moves, or doesn't move, around the world. Here's the problem. Shanghai wants to keep silver in China, hence the export restrictions. New York needs silver to settle COMEX contracts, but the vaults are running thin. London sits in the middle, trying to service both east and west. With diminishing inventory, 3 cities, all competing for the same finite resource, all trying to maintain the illusion that their markets still function normally, all pretending the system isn't breaking down in real time, but the cracks are showing. And Shanghai's position limit reduction is just the latest admission of failure. Because when you can't source enough physical metal to back your futures contracts, when deliveries become uncertain, when price discovery completely disconnects from physical reality, you have 2 choices. Either let the market collapse under its own weight, or intervene with restrictions, limits, controls. Shanghai chose intervention. The COMEX chose automated margin escalation. London is quietly watching, waiting to see which approach survives. But here's what none of these solutions address. The structural deficit, the fact that industrial demand for silver has exploded over the past decade. Solar panels alone consumed over 200 million ounces last year. Electronics, batteries, medical applications, water purification, The uses multiply while mine supply stagnates. Every year, the world consumes more silver than it produces. Every year, above-ground inventories decline. Every year, the gap widens. And no amount of position limits or margin hikes changes that fundamental equation. Which brings us to the real driver beneath all of this: inflation. Not the 3% or 4% inflation that central banks pretend is transitory. Real inflation. The kind that destroys currencies. The kind that sends people scrambling for hard assets. The kind that makes silver, gold, platinum, palladium surge in value, not because metals are becoming more valuable, but because the paper currencies they're priced in are becoming worthless. And that's the inconvenient truth that Shanghai, the COMEX, and London all want to avoid. These restrictions aren't about managing speculation. They're about hiding monetary collapse, about maintaining confidence in a system that's already failed, about buying time before the inevitable reckoning. But time is running out, because eventually one of three scenarios must play out. Scenario 1. The COMEX price surges to meet Shanghai's physical reality. Paper contracts explode higher as traders realize Western prices are artificial. Silver hits $100, then $120, then higher still. The two banks with massive short positions collapse. Contagion spreads through the financial system. And precious metals enter a parabolic phase that makes 1980 look tame. Scenario 2. Shanghai's physical market collapses back toward COMEX levels. Chinese demand evaporates under regulatory pressure. Position limits successfully suppress price discovery. Silver retreats to $60, $50, perhaps lower. The bull market ends, and everyone pretends the disconnect never happened. Scenario 3. The markets split permanently. East and West decouple entirely. Two separate silver prices emerge, one for physical, one for paper, and the global financial system fragments along geographical lines. Which scenario unfolds, no one knows for certain. But what we do know is that the current situation cannot persist. Markets that trade the same commodity at 30% plus price differentials don't last. Systems built on paper promises when physical supply is exhausted don't survive. Confidence games only work until confidence breaks. And we're approaching that breaking point. Fast. The night session of January 19th is just the beginning, not the end. What happens in the days and weeks following those restrictions, that's when we'll see the real impact. When traders adjust to the new reality, when supply chains either adapt or fail, when the two big banks either survive or collapse, when silver either consolidates near $90 or explodes toward $100 and beyond, the countdown has already started. And unlike previous silver rallies, this one isn't driven by speculation. It's driven by shortage, by monetary debasement, by industrial demand that cannot be met, by a system that printed too much currency for too many years with too few consequences until now. Because silver, unlike paper, cannot be printed, cannot be created by central bank decree, cannot be conjured out of thin air. It must be mined, refined, transported, stored. And when those physical processes break down, no amount of regulatory intervention fixes it. Shanghai learned this. The COMEX is learning it. And soon, the entire world will understand that we've entered a new era for precious metals, one where the rules have fundamentally changed, where East and West no longer agree on price, where paper and physical have diverged permanently, where $100 silver isn't a target. It's an inevitability. The only question remaining is what breaks first? The shorts, the banks, the system itself, or the illusion that any of this was sustainable? We're about to find out.